So I can now introduce you to the organising committee. So we've got Cavett, who is the chair, and Phoebe, who is the vice chair of Positive Investment Imperial. I'm vice chair of research, and my job is to author thought pieces and regular news bulletins to share the latest news and events in the space. We have our co-vice chairs of events, Sin and Celia, who are responsible for putting on some excellent events that we've had throughout the year on university endowments, on building back better from COVID-19, and also, of course, the symposium today and yesterday. And lastly, we have our endowments team made up of Luke and Beryl, who have spent this year researching best practices on socially responsible and sustainable investing policies. And they've been providing consultation to the endowment SRI policy engagement group on bringing a holistic approach to Imperial's climate targets and building out a stakeholder network. So you'll be seeing us around throughout the day, and feel free to post any questions in the chat. We also wanted to thank our partners and collaborators, so Imperial College Business School, Centre for Climate Finance and Investment, the Grantham Institute for their partnership and support, and especially to Martin and Charlie as the programme directors of the master's programme that many of us are on, Climate Change Management and Finance. Also Ben and Sam, Positive Investment, Cambridge and Oxford, and students organising for sustainability, and specifically Mel Key, who has been kind of instrumental in bringing everything together today. Also Lily Thompson from Chair Action has been incredibly helpful and was the co-founder of Positive Investment Oxford, Tony Hay from Responsible Investor, and also all of our speakers and moderators from all kinds of different organisations who have pulled together and helped us to put on excellent events over these couple of days. So thank you very much to everyone who has helped out. I'll now pass on to Cavett, who will introduce the theme for today and our first speaker.
Thank you, Claire. So today is all about universal ownership. So at 2:40, we'll be learning about university engagement from students and finance directors. Then at 4, we're going to dive into the world of responsible banking, learning about what we can do as retail bankers to create positive impact. And then our last panel at 5:05, we'll be joined by leading actors who are helping to drive finance into biodiversity. And we'll finish off the day by Martin Seagoat from the Grantham Institute with some closing remarks. But to start us though, we're lucky enough to have Dr. Ellen Quigley here as our keynote speaker. So Ellen is the driving force behind the research and implementation of Cambridge University's responsible investment practices, as well as a senior research associate in climate risk and sustainable finance at CSER. Having studied at universities of Harvard, Oxford, and Cambridge, Ellen has passionately confronted issues around ownership and finance for years. And when at Cambridge, she helped found Positive Investment. We're really looking forward to what Ellen has to say. So without further ado, I'll hand over to her now.
Thanks, Cavett. Well, it's a real delight to be with you all today, and what a great set of discussion topics. Couldn't appreciate them more given the absolute urgency of the situation that we're in, but also the tools that we have to use as members of powerful educational institutions. So great lineup. So I'm going to try to pull together some of the things that you will be discussing later today and have already discussed yesterday in one kind of practical or theoretical framework called universal ownership. And basically, universal ownership is just the idea that if you own a more or less representative slice of the entire financial system, because you're a diversified long-term owner of capital. So this would include pension funds, university endowments, foundations, sovereign wealth funds, those sorts of blocks of capital. If you are diversified in that way across geographies and so on and so forth, which is really what modern portfolio management entails, then you can't stock pick your way out of systemic risks. And by systemic risks, I mean risks that can affect, many or all parts of the economy and human lives and the environment. So a couple of examples would be climate change and coronavirus, just to pick two. And these are things that you can't avoid by having an elaborate stock picking strategy. And what that kind of forces you to do as a universal owner is to flip things around. So and I'm sorry to be so down on ESG as it's currently practiced, but I have to say that most ESG gets things precisely the wrong way around, because it's based on the idea that you can protect your portfolio from risks posed by things like climate change and inequality in the coronavirus. So it is particularly a stock picking exercise, because when you own stocks, that's where most of the risk and return is going to be in the average portfolio. I'm not talking about hedge funds and private equity for the moment, but bonds are supposed to be safer. Public equity tends to get you your returns. So that's where the risk is. And therefore, most ESG funds are public equity funds. And the idea of stock picking in those funds is that you can protect yourself from risks like climate change. But if you're a universal owner, you actually need to reduce the risk of climate change in the real world. That's the only way you can actually protect your whole portfolio. And just to drill into that for a moment, what that means is that if you were, say, engaging with Exxon, you would prefer, if you're a universal owner, for Exxon to wind down their oil and gas operations over time. If you were to be, or transition, but I don't think Exxon is a particularly good example of a company that can actually transition given their extreme history. Anyway, so the idea is that you would want Exxon to actually reduce its impact on the environment and kind of phase itself out. But if you are an ESG investor, you might actually just want Exxon to protect its assets, like maybe ocean rigs. You might want them to build them a little bit higher to account for sea level rise, instead of trying to get Exxon to actually reduce their part in creating sea level rise in the first place. So it really is flipping things around. And that's a bit of an extreme example, but that is the sort of mindset that you get into with these two different paradigms. So universal ownership is about impact. It's how is my portfolio having an impact on the real world, and how can I mitigate these terrible effects of things like climate change. Whereas ESG is very much I'll put it kind of baldly, it's a bit of a selfish endeavor. It's meant to try to protect your own portfolio. But even that can't work, to be honest. If you are a long-term investor, there's no way that you can protect yourself from the headwinds that we face. So it's a very critical paradigm shift in how you approach investments. How do I have an impact, not how can I protect my own portfolio? And the best ways to have an impact are twofold. I'm going to concentrate on two for the moment. One is to do with engagement in public equity. So currently engagement is quite useless. I've looked into a lot of research on this, and it's upsetting because the vast majority of shareholder engagement tends to be very ineffectual. A lot of it centers around shareholder resolutions, which tend to be advisory. They also tend to fail. But the few that do pass the 50% mark, their implementation rate is low. And even if something gets implemented, usually the resolutions that manage to pass through all of those steps are disclosure related. And I've also looked into disclosure. I can't find a firm correlation between disclosure and actual improvements in environmental performance. This might be different, by the way, for mandatory disclosure, but if disclosure is voluntary, you don't tend to see a real effect flowing from disclosure, because my suspicion here is that companies think this is a step that I can be shown to have taken in the face of engagement or public pressure. And it's almost a distraction to disclose. But again, disclosure doesn't get you anything in and of itself. It does allow you to see clearly what needs to change, but it's not enough. And private engagements, similarly, from what I've seen, many of the asks in private engagements are disclosure or reporting related. So people aren't actually asking for changes in emissions, for example, reductions in emissions or other kind of real world shifts from companies. So if they're not even asking that, how can we expect engagement to get us to an actual decarbonization timeline that aligns with the emergency that we're facing? So it's very depressing, very worrisome to look at this evidence, but there are some interesting kind of elements that come out. One of them is that voting against the re-election of directors can actually be quite effective, and you don't have to win. And this is because these directors are used to getting 99% of the vote, more or less automatically. So if they get 92%, they freak out. This is a high status group of individuals. They have a lot of stock put in their reputation. So to see that there's, meaningful percentage of investors who don't support them in their leadership role, that's actually the biggest threat to them. And also, if it got to the 50% threshold, they would lose their job. So they know, if you're starting to see a shift this year, what could next year look like? Really starts the wheels spinning. They tend to then get their CEO, their executive teams to do what's necessary to satisfy the wishes of the shareholders who voted against the directors. So it also happens to be extremely cheap. You have to vote on director elections anyway, or most investors do. And instead of doing the automatic vote in favor of the directors, all you have to do is vote against instead and tell them why. So that's, it's hard to get a cheaper or simpler way of doing shareholder engagement than that. By the way, the other fairly effective form of shareholder engagement has to do with being excluded from an index. So there have been a couple of studies looking at an ESG index, and the companies that were threatened with being excluded from it were much more likely to accede to the requests to kind of the standards of the index. So, the threat of exclusion, and especially when it's public, and voting against directors, probably also if it's public, but I don't know that based on the evidence. So you've got a couple of tools that seem to work in shareholder engagement. Very few people seem to be using it, although I'm hearing more and more lately that people are voting against the re-election of directors, and that makes me delighted because we're likely to see more actual outcomes from that. But I guess the real takeaway here is you need to be a very active shareholder if you're going to own those shares. And I'm just going to take a quick interlude here to talk about divestment, because I do think it's compatible with universal ownership theory. I think that if you're going to divest, you have to make a big deal out of it publicly, because it's a whole separate theory of change. And I think it's a legitimate one, having looked into all of the research on this in a report for the University of Cambridge. And Cambridge did divest in October. The idea is that we can't actually make the appropriate change we need without appropriate legislation at the country level. And I think most people would actually agree with that. That seems to be just the natural need for sensible movement on climate change. But how do you get legislation when you have companies that have a powerful lobby and not sufficient, somewhat insufficient public support for policies that aim at specifically phasing out fossil fuels? I mean, you have a lot of support for building wind turbines and stuff like that, but typically there's not as much support, or there's more opposition to the idea of phasing out fossil fuels themselves. But what divestment does is it targets specifically the sector where the emissions are coming from, and that is fossil fuels, mostly. I mean, they're agricultural emissions and so on, but the vast bulk of emissions are coming from fossil fuels. And what the divestment movement is meant to do is to discredit, to stigmatize that sector, such that they can become legislatable, because human societies don't tend to legislate things that they don't view as wrong in some way. So you have to create the conditions in which legislation can happen. And the way to do that is to make this sector be kind of wrong enough to be legislated. So I think divestment is a completely legitimate way of addressing specifically the fossil fuels question. You just have to make sure to announce it, because it is a public discourse play. But it shades into my other point about what you should do as a universal owner, because it turns out that in other asset classes, aside from public equity, where there really is no what's called additionality, which means that extra money that you put in doesn't help or hurt the companies, because when you sell a share, by definition, someone else is buying the share and the money is not going back to the company. But when you do give new capital to companies is often in the form of debt. So let's use Exxon as an example again. You might own Exxon's shares, or you might have publicly divested from them. But you may still purchase their bonds every few months. A lot of these very big companies will issue bonds, a couple times a year, sometimes more, sometimes less. Every time they do that, when you purchase a bond, you are lending money to that company, directly to that company. And that's where most new capital for fossil fuels is coming from. 90% is debt. And about 2/3 of that is bank lending. And another big chunk is bond issues. So bonds are when you purchase a bond and you're lending money to the company that way. Bank loans are just loans as you would understand them, but banks also underwrite capital markets transactions for companies. And what that means is that they will underwrite the bonds that you might purchase, or they will underwrite an IPO or initial public offering. That's when a company lists on the stock market in the first place, and the company does actually get the money when they first list on the stock market. So you have to look at where new capital is coming from if you really want to have an impact. So you'll have a whole other strategy for public equity, but when you're looking at debt, that's when it really matters what you own, what you choose to purchase. And I would hope that any universal owner would have an even stricter filter on which things they own on the debt side than anywhere else. And public equity has some additionality as well. There's not as much work that's been done on this, but there is some additionality there. And what's interesting about public equity is that you tend to see specialist managers. And what that means is that you're unlikely to get a fund that is like a little bit fossil fuel-y. You'll either see a specialist oil and gas fund that all they do is oil and gas, and then another one that has its focus, health or tech or something like that, and they won't own any fossil fuels. So it's actually easier to divest in private equity than you would think. So anyway, all this is to say, if you were worried about having an impact with your investments, it does not help to do an ESG screened index. That is rearranging deck chairs on the Titanic. It is useless. What you need to do instead is to worry about how you are engaging in public markets. And that means being much more aggressive and tactical and using the evidence to make the best use of the tools that you have, especially voting against the re-election of directors. And in other asset classes, that's when you want to apply a filter to what you own, because you are actually supporting those companies every time you invest in them. And there already is evidence to suggest that the cost of capital, so that is the cost at which a company can borrow, for example, has already risen because of divestment of fossil fuels, even though many of the institutions that have divested from fossil fuels only did so in public equity. So there's a lot more that can be done in this space, even among institutions that claim to have divested already. And there are a lot of ways that you can have an influence as well in terms of popularizing these concepts, helping the field to understand the ways in which ESG investing is not fit for purpose given the state that we're in now, and what can be done instead. I'd love to take questions if anyone has them.
Thank you for that, Ellen. I think if I should look at the Q&A. So we have one from our own Luke at PI, who said, if engagement doesn't work, then what is the best way to curb the emissions and change the trajectory of high emitting companies and sectors? Are we entirely reliant on legislation coming in to solve the problem?
So we do need legislation, that's for sure. But I think we kind of need all of the things is what you could answer. So we need legislation, absolutely. And actually investors can push for that too. Public policy engagement. I mean, fossil fuel companies are doing it. So, if you want to counter that lobby, governments need to hear from people who want this kind of legislation too. But again, most shareholder engagement to date has been pretty useless, but there are things that work. So the voting against the re-election of directors, I really don't think that has been tried as much as it could be. And you could have a standard against which you tell the companies that they'll be measured. So you can say, I'm going to vote against directors unless these specific conditions are met, that sort of thing. And by the way, sorry, just one side note, it's all about fossil fuels. I know that we get distracted a lot by institutions telling us about how much green investing they're doing. Again, we have a carbon budget. You could build as many solar panels as you want, but if you continue to expand fossil fuel burning, we haven't got that. Climate change will continue to get worse. So really focusing on fossil fuels for that question is pretty critical.
Thank you for that. I think that's, unless anyone else has any questions from the audience. I have one that I'm interested about. The methods of engagement you're talking about, are they standardized across the world? So is the way that I can engage, say, here in the UK, the same that someone can engage with, say, in Kenya, or do they vary?
Really, really good question. So where you tend to see legal regimes apply is at the stock market level for publicly listed companies, which is where most of your engagement will be. And those rules do vary by country. And I'm not an expert on this, but I can tell you that filing a shareholder resolution it can be quite different country to country, depending on the legal regime. But that said, to my knowledge, every jurisdiction votes on director re-elections. So it's kind of funny, even though it's a much more effective tool, it's used much less, and it's even much more applicable across jurisdictions. So although it definitely does affect what you do, if you're trying to file a shareholder resolution, the most standardized thing you could do would be to vote against the re-election of directors. And by the way, the resistance to that tends to be that it's kind of uncomfortable, because it's seen as a bit of a nuclear option to kind of threaten to kick somebody out of their job. But I would argue that that seems like a small price to pay given where we're at.
Okay, thank you. We've got a couple more questions now. So from Beryl, she said, how about on the demand side? Many consumer companies, fossil fuels are also not on track. How does that leave the investable universe?
Very good question. So I actually spend a lot of time looking at utilities for this reason, because utilities are already decarbonizable in most jurisdictions just based on price and current technology. So, solar and wind are cheaper than coal in all major markets now, as of like a year and a half ago. So there's really no reason to be building any more coal plants, and gas plants. That's looking like solar and wind will be able to catch up there too, et cetera. So, and that is a huge proportion of our overall demand, emissions related demand. So about 40% of global emissions come from electricity power generation. So yes, that demand side of that equation is absolutely critical. The other thing that I'll mention though is that the research that I conducted for the divestment report for the University of Cambridge kind of shifted my mindset a bit to thinking about both demand and supply. And there are scenarios that academics have worked out wherein, even with quite substantial cuts in demand, you end up with a lot more supply coming in and keeping the prices really low, such that it makes the transition away from fossil fuels actually more difficult. So I would say we need a fossil fuel non-proliferation treaty, and that's a thing. So look it up, feel free to sign on, get your institutions to sign on, because that will actually control in a fair way the supply of fossil fuels. But then, I think it's a very good point that we need to work on demand as well. And I would start with utilities because we already know how to decarbonize that sector. And it's a huge sector in terms of emissions. By the way, we do actually know how to deal with the vast majority, or a large majority of oil demand as well, just by electrifying transport and improving public transport, especially. So, the hard to abate stuff does tend to account for a smaller slice of overall emissions, and we could get started quite substantially by just looking at utilities and autos to start with.
Thank you. And we've also got one question from Benjamin, who says, if divestment is growing in effect, is the threat of divestment becoming a more useful strategy for those investors who engage?
Oh, that's such a good question. I don't know the answer to that. I hope you're right, but I don't know. I do suspect that, it's now in the risk reports of all sorts of companies. They list divestment as an investment risk or a risk to the company. So if they're listing it there, it must be having an effect.
Okay, thank you. I think we've got time for one last question from Sam. So he said, on voting against directors, can universities vote their shares in mutual funds directly, or do they have to request their asset managers vote against directors on behalf of all investors?
It depends on your fund manager, basically. So a lot of very large pension funds recall all of their votes and they vote them themselves. But a university endowment is going to be a smaller player for their fund manager, and the fund manager might just kind of decide they don't want to do that. Some fund managers will just vote how you want. Others will just give you the vote back so that you can do it for yourself, and others will just refuse to do any of that. So it just depends.
All right, thank you. I think that's all the time we have for questions. I just want to say a big thank you again for kicking us off, and I think can speak for everyone. Yeah.
Can we take another question?
You want to take more questions?
Yeah, well, there's so many good ones, and so
right, everyone, all the attendees, we're going to sacrifice the break, and we'll take some more questions. As long as Ellen, is that fine with you?
Sure. Yeah, I can stay for a few more minutes. Yeah.
Okay.
All right, cool. So we'll move on to. Have you got a particular one?
Yeah. So Lionel Welch asks, are there particular directors or companies you would focus on, or all directors at fossil fuel companies?
So I might be a bit extreme, but I think there are no fossil fuel companies that are aligned with the Paris Agreement. So I would vote against all of them. But I would also vote against the directors of all of the world's biggest banks, because banks are absolutely critical. Again, go back to what we were talking about before. 90% of new fossil fuel financing comes from debt, and banks are enormous players in all of that, including actually with public equity or initial public offerings and so on as well. So I would vote against an awful lot of directors if given the choice. Quite a few utilities as well, most utilities. And also, just to highlight this, any company that was planning on building new fossil fuel infrastructure of any kind and exploring for new resources. We don't need any of that. Oh, also no more deforestation. We've got enough land that has been denuded that we can actually feed all of us with the land that we've got. So yeah, I would end up voting against an awful lot of directors.
Okay, thank you. Have you got time for one last question?
Sure.
All right, great. So this is along the, so I'll go through from Aaron, who says, as we progress down the journey of ESG investing, we hear systems-based thinking approaches more frequently. When companies look at issues like climate change, workplace equity, and the ethics of emerging technologies, these all effectively involve systems-based thinking and approaches. Can you please share your thoughts on companies focusing on systems-based thinking and addressing climate change?
Wow. Okay, there's a lot here. I'm probably only going to take on a couple of facets. I mean, I think that if you're a universal owner, you automatically have to think in terms of whole systems. You don't have the luxury of being able to take things piece by piece. And if you look at climate change, I actually highly recommend that everyone watch the last David Attenborough. It's like an hour-long film called Extinction, because it does an amazing job of tying together a lot of our current struggles that are all systemic. So it ties together climate change with biodiversity loss and soil erosion. That one's huge, by the way. We don't have very many harvests left, and that's a total nightmare. Zoonotic diseases like COVID, because of deforestation and habitat incursion and so on and so forth. We are dramatically increasing the potential that we will have pandemics like this one, etc. So actually, you can link a lot of these together quite well. And just to talk about inequality for a moment, you actually don't do a very good job of dealing with climate change unless you have a measure of unless you have a measure of equality in your society, because you just can't. I mean, it erodes democracy to have inequality. I think we've seen a lot of that in the last couple of years. You have high levels of inequality in your country, it tends to erode democracy, and that's the basis on which you're able to get the legislation that we need for climate change. And so you get Gilets jaunes in France, for example, for bringing forward some kind of carbon pricing regime, whereas the stories that people don't know about would be in British Columbia and Canada that passed carbon dividend more than a dozen years ago, in which they people who were on the lower end of the income scale got more money back than richer people overall, and the support for that policy went up afterwards. So you have to think about these things in a systems way. You have to recognize that inequality, climate change, biodiversity loss, soil erosion, pandemics, all of that, they're all interlinked, and we kind of have to think about them together.
All right, thank you for that. I'll have to end the questions there, but big thank you again. I think it's definitely made something about where universal ownership sits in this fight against climate change. So that's perfect for today. Thank you.
Thank you very much. My pleasure to be with you all.